Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. We are jumping right in today, taking a close look at the latest communications from one of the true titans of global retail. We're talking about the major warehouse club, of course, and we're focusing specifically on their first fiscal quarter, which is that key 12-week period that ended back on November 23rd. You know, their whole model is built on this kind of sacred promise to the member. It's all about superior value, and that value comes from superior efficiency. But keeping that promise gets harder every single year. I mean, you're facing inflation, your own labor costs are going up, and just scaling that physical footprint around the world it's a huge challenge.
It's a huge challenge.
Hmm.
And the story that really came out of their communications isn't just about big sales numbers. It's more of a playbook. It's a playbook for how they're fighting all those headwinds we see in the economy. They're doing it with really aggressive and, frankly, highly creative physical expansion. But at the same time, they're adopting some pretty sophisticated tech, including some very practical AI, to protect that core thing, that membership model.
Right.
So that's really our mission here, to understand that balancing act. It's one thing to just look at the net sales and say, wow, that's a big number. But the real insight comes from putting the quantitative, the numbers together with the qualitative strategy.
Okay, so how do they manage to do it? How do you gain market share in almost every single department when your own wage and healthcare costs are going up significantly?
It's all about their flywheel. I mean, that's the term they use. And it's working better than ever. The idea is simple. Efficiency generates savings. And then instead of just banking those savings, they immediately reinvest them into lower prices for you, the member. We're going to examine how they're modernizing their physical warehouses, not getting rid of them, but making them better with new real estate ideas and very targeted tech.
Okay, so let's start with the absolute foundation of the whole business, the bedrock. Because unlike almost any other retailer out there, their profit doesn't really come from marking up, TVs or groceries. It comes from selling you the right to walk in the door. We're talking about the membership model, the membership fee income, or MFI. How healthy is that foundation right now?
It's the golden metric for them. And the scale is it's staggering. So at the end of the quarter, they had 81.4 million total paid members.
81 million.
But then you have to account for the other people on those memberships, the household card holders. When you add them in, the total number of people with a card in their wallet is 145.9 million.
Wow.
And both of those numbers are growing at over 5% year over year. That constant stream of new signups is what fuels everything else.
And the actual fee income, the MFI, that growth was really strong this quarter. I think it was up 14% year over year. Now, a big piece of that we know was the fee hike they put through in the US and Canada last September. And everyone was watching to see, how much of that 14% is real organic health versus just a price increase?
That's the critical question.
Yeah.
And it's why you have to dig into that number. So yes, the fee increase was a factor. It accounted for a little less than half of that 14% growth. But here's the really interesting part, the strategic part. If you adjust for foreign exchange rates and you just completely take out that boost from the fee increase, the membership fee income still grew by a very, very healthy 7.3%.
Okay, let's pause right there. 7.3%. So even if they hadn't raised the price at all, they'd still be growing membership revenue at over 7%. To me, that's the proof. That shows the value proposition is still incredibly strong. People are not blinking at the cost because the savings are so obvious everywhere else in their budget.
It absolutely validates the model.
Yeah.
That 7.3% it's pure organic momentum. It's not financial engineering. It comes from just two things. One, just expanding the total member base, so net new people signing up. And two, and this is critical, existing members choosing to upgrade to the higher executive tier.
And that executive membership, that's really the engine room of the whole loyalty strategy, isn't it? These are the people who spend more, they come in more often, and they are famously loyal when it comes time to renew.
Exactly. They're the core.
Yeah.
And the growth there is actually accelerating.
Yeah.
Paid executive memberships were up 9.1% year over year. That brings the total to almost 40 million members, 39.7 million. And that cohort is so important because they just drive way more sales volume. I mean, they account for less than half the members, but often generate more than 2/3 of the company's total sales.
So when they renew, it guarantees this huge, predictable stream of high-margin income.
Exactly.
Okay, but speaking of renewal rates, this is where things get a little more interesting. We did see a tiny dip. I think it was 10 basis points. So the worldwide rate is now 89.7%, and in the US and Canada, it's 92.2%. For a company that's famous for loyalty, any dip, even a small one, kind of makes you look twice. What's going on there?
Yeah, it's a good question. And this isn't a sign that the model is weakening. It's actually a byproduct of their success in attracting a new type of customer. Management was really clear about this. They said the decline is specifically because of a growing group of new members who signed up online, digitally.
Oh.
These members tend to be younger. They might not have fully built the warehouse club into their weekly routine yet. And historically, they just renew at a slightly lower rate than someone who physically walks into a warehouse and signs up at the counter.
So as more of these younger digitally native members come up for their first renewal, they're mathematically pulling the overall average down a tiny bit. So this is less of a crisis and more of a new strategic challenge. But could it become a bigger problem down the road?
It could if they just ignored it. But that's what was so interesting. They're not ignoring it. They're actually treating this group like a test lab for how to manage the next generation of shoppers. They actually expected a bigger decline than the 10 basis points they saw. And the reason it wasn't worse is because they got ahead of it with very targeted communications.
So they didn't just wait and see. They use their tech to actively manage this specific group. What does that look like?
It means they're using personalization. So if your digital membership is about to expire, you might get a targeted email or an app notification that shows you the value you're getting.
Like, hey, did you know your executive rewards check was this much? Or look at how much you saved on gas last year?
Exactly that. It's about showing, not just telling, the value. And the fact that it worked, that it mitigated the decline, suggests they're figuring out how to make these digital-first shoppers just as loyal. They're turning a headwind into an opportunity.
That's a great insight. Using your data to manage the health of your core revenue stream, not just to sell more stuff.
Yeah.
So beyond that, what else are they doing to make the membership more valuable and get more people to upgrade to executive?
Two big things recently: convenience and digital services. First, they extended the operating hours.
Right.
Executive members now get an extra hour to shop in the morning on most days. That's a huge tangible benefit, especially if you're a small business owner or you just hate crowds.
And the second thing?
They added more value to the delivery channel. So now if you're an executive member and you shop through Instacart, you get an extra $10 monthly benefit.
Okay, the extended hours thing seems like a big deal. That costs money to keep the lights on and staff the store. Are they sure it's actually creating new sales? Or is it just moving sales from 10 a.m. to 9 a.m.?
They're confident it's creating new sales. For one, it's driving what they called a nice uptick in executive upgrades, which is the main goal. But they also estimate that just that one initiative, just the extra hour, contributed about a 1% lift to total comparable sales.
1%, just from shifting hours. That's a really big number. How does that work?
It's a couple of things. By spreading the traffic out, it makes the store less crowded during the peak hours later in the day. So the experience is better for everyone.
Ah, okay. A better experience means you might stay longer, buy more.
Exactly. And it gives your best, highest spending customers, the executive members, a real feeling of exclusivity and convenience. It just reinforces why they pay more for that black card. It proves that investing in the physical experience pays off on the bottom line.
Okay, so the membership is strong, the high-value tier is growing fast, and they're managing the risks. That strength is what gives them the cash to expand. Which brings us right to our next topic: fueling that growth with physical expansion and some really innovative real estate.
Yeah, their bet on brick and mortar it's unwavering. I mean, they're putting their money where their mouth is. Capital expenditure for the full year is guided to be around $6.5 billion.
That's a lot of concrete and steel.
It is. And in Q1, they were busy. They opened 8 new warehouses globally. That includes some relocations and business centers.
Yeah, I saw they added a third warehouse in France and 2 new business centers in Canada. But I also saw a little tweak to their future plans, right? The target for fiscal 2026 was pulled back just a bit.
It was, but it's a very minor adjustment. The target was revised down a little to between 20 and 28 new openings. And they were very specific about why. It was because of delays on just 2 buildings in Spain.
So it's not a change in strategy, it's a specific project delay.
Exactly. This is just a little blip. The long-term goal is still very aggressive. They're planning for 30-plus new openings a year in the future. And to back that up, they've actually expanded their real estate team to go find those locations.
Well, and that's the fascinating part. In places like the US and Canada, finding a huge 15 or 20 acre lot for a new store it's almost impossible now, or it's way too expensive. So how are they getting creative to get into these tight markets?
They are getting extremely creative. It's a big strategic pivot for them. We're seeing a few different approaches. In Mulhouse, France, for example, they just took over an old existing hypermarket and converted it. No ground-up construction.
Smart.
In Canada, they did something similar. They opened 2 new business centers by taking over and refurbishing old home improvement stores. So this adaptive reuse saves a ton of time and money.
That's clever. But the most complex example, the one that really shows how far they're willing to go, is these mixed-use projects. Tell us about that one near LAX.
The Baldwin Hills project in California it's really groundbreaking for them. They're actually partnering with developers to build affordable housing on top of the future warehouse.
Yeah.
Management said a prime spot like Baldwin Hills would have been completely off the table for them using their old traditional model. There's just no way to get that kind of land footprint in such a dense area.
So this is a way to unlock markets they couldn't get into before.
It's a total game changer. This kind of vertical development, it's slated for 2027. It just shows they're willing to get into these really complex deals to secure future growth in these key urban markets. It solves a real estate problem and a community problem at the same time.
And that ability to get into better locations combined with relocating older, successful stores, that has to be driving the performance of the new buildings. And those numbers were, frankly, they were kind of stunning.
They are getting a much faster return on their investment. The new warehouses they opened in fiscal 2025. They generated an annualized $192 million in sales in their very first year.
Okay, $192 million. Put that in context for us. How does that compare to new stores from just a few years ago?
It's a massive jump. Just 2 years ago, a new opening was doing about $150 million in its first year. So that's a 28% increase in first-year performance.
Wow.
It just means these new buildings are getting profitable much, much faster, which means they can afford to build even more of them.
So why is that happening? Why the huge jump?
It's strategic placement. It's not just about building in new areas. It's also about strategically relocating existing high-volume stores that are they're too small or they don't have enough parking. They have 5 of those relocations planned for FY26.
And when they do that, when they move a busy store to a bigger, better site nearby, what happens to sales?
The impact can be huge. They're targeting places where they know the demand is there, but the building is the bottleneck.
Yeah.
These moves can lift sales anywhere from 20% up to 50 or even 60% if they can add a gas station or drastically improve the parking situation.
So you have these 2 different types of expansion. How do they balance the portfolio?
It's a very calculated mix. The infill locations, mostly in the US and Canada, they drive sales really fast because they're just soaking up existing demand from other nearby overcrowded stores.
So that's your quick return.
That's your quick return. But then the openings in new international markets like Sweden or parts of Asia, those are all about driving massive numbers of new member signups. They might take a bit longer to hit that $192 million sales mark, but they're growing the core membership base for the long term.
That really makes that $6.5 billion investment number seem a lot more strategic. Okay, let's switch gears. Let's talk about how they're using technology to make that physical experience even better. This brings us to what you call the technology triumvirate: digital, personalization, and AI. And they were clear, this isn't tech for tech's sake.
Not at all. The digital side is still growing like a weed. Digitally enabled comp sales were up 20.5%. That's driven by huge engagement. Website traffic was up 24%, and app traffic that surged 48%.
48% in the app, that's huge. It's becoming a real tool for shoppers, not just a gimmick.
Absolutely. And their same-day delivery services, Instacart in the US, Uber Eats, and DoorDash in other countries, those are actually growing even faster than their overall digital sales. Convenience is king.
Okay, digital growth is great. But what really jumped out at me was how they're using tech to improve productivity inside the warehouse. They're fixing the one thing we all hate, the checkout line.
Yes. The focus is all on reducing friction. So they're doing simple but effective things, scanning memberships at the door more consistently, pushing the digital wallet in the app, and the big one, introducing pre-scanning for people with small to medium-sized carts.
Okay, tell me about that pre-scanning. What was the actual impact?
This is the real aha moment.
Yeah.
So an employee with a handheld scanner walks down the line and scans your items before you even get to the register. In the stores where they tested this, it improved checkout speed by up to 20%.
20%.
20%.
Yeah.
And it was so successful that it helped their entire U.S. warehouse system hit record levels of checkout productivity at the end of the quarter. That is a direct return on a technology investment. It saves time, it saves labor, and it makes members happier.
Okay, let's talk about the other big buzzword, AI. They say they're using it in a practical, member-focused way. So they're not building fancy chatbots. They're starting with inventory.
That's the perfect example of their philosophy.
Mm.
They started with something fundamental, almost boring, the pharmacy. They
Yeah.
built an AI system into their pharmacy inventory. And it does two really complex things automatically. First, it's constantly checking prescription drug prices from all their different vendors to make sure they're getting the absolute rock bottom cost.
Yeah.
And second, it automatically reorders drugs based on real-time sales and demand forecasts.
And what did that actually do? Was it a small improvement or something bigger?
It was transformational for that department. The AI system got their in-stock levels up to over 98%. That reliability helped drive mid-teens growth in the number of prescriptions they filled. But more importantly, because the AI found all those cost savings, they were able to lower prices for members on thousands of different prescription drugs. It's the flywheel in action. The tech creates efficiency. The efficiency funds lower prices.
That's a perfect example. So what's next for AI? Are they rolling this out to other departments?
Yeah, the next target is the gas business. They're deploying similar AI tools to manage gas inventory, to make sure they're always in stock and always offering the best possible value. And long term, they see it improving, well, everything. Procurement, supply chain, even employee training.
Yeah.
But it all comes back to that one goal, using tech to drive the lowest possible price.
And they're also using all that member data for personalization, right? How is that going?
It's going very well. The early results from just basic online personalization, showing you relevant products based on what you've bought before,
Yeah.
that created a very positive sales lift.
So that leads into the bigger idea of retail media, which every retailer is talking about right now. How are they approaching it? Are they just trying to build a big, high-margin advertising business?
They see it as a huge opportunity, but they're approaching it very differently than other retailers. Their philosophy is that the majority of the money they make from retail media will be reinvested back into lower prices for the members.
Wait, so they're intentionally not maximizing the profit from it? Why would they do that?
Because their ultimate competitive advantage is value. They believe that if they can go to a national brand and say, hey, your ad dollars with us aren't just lining our pockets, they're actually helping us lower the price of your product on the shelf.
Which then drives more sales for that brand.
Exactly. It makes their ad spend more effective. So they're putting the member experience first and using the media revenue to fuel the value flywheel even more.
And how are they doing that? What are the new channels?
Well, they're building out the tech platform to do it all at scale. But one of the first new channels they've launched is advertising on the gas pumps.
Oh, that's smart.
It's brilliant. It's a high-frequency visit, and you have a captive audience for a few minutes. It's a perfect place to reach members.
Okay, this whole picture is starting to come together. Let's shift to the final segment and look at the actual financial performance and see how this all translated into sales on the floor.
The top-line numbers show really solid momentum. Net sales hit almost $66 billion. That's $65.98 billion, up 8.2% from the year before. Comparable sales were 6.4%. But if you strip out the effects of falling gas prices and foreign exchange, comp sales were even stronger at 7.1%.
And that growth was really well balanced, right? It wasn't just higher
This
prices.
is perfectly balanced. Traffic, so how often people are shopping, was up 3.1% worldwide, and the average ticket size was up 3.2%. You want to see both of those numbers growing together. It means more people are coming more often and buying more when they're there.
And net income was up over 13%, so they're managing the margins well.
Very well.
Let's talk about that margin management, though. Specifically, the SG&A line, the cost of running the business. It actually went up by a single basis point, which seems weird in a quarter where they were talking about record productivity. Why didn't it go down?
This is probably the most important financial detail of the whole quarter, and they were very open about it. There were 4 specific headwinds that completely offset all those amazing productivity gains. The first 2 were planned. They were strategic investments. One was higher wages from their new employee agreement. The other was the cost of running those extended hours for executive members. They chose to spend that money.
Okay, so paying your people more and giving members better service, those are good costs. What were the other 2?
The other 2 were more unusual. One was a small tax charge from prior years that hit the SG&A line. That's a one-time thing. But the fourth one is the one to watch. They saw significantly higher healthcare costs. And for the first time, those costs actually grew faster than their sales did.
So health claims just shot up unexpectedly. Is that a problem for them specifically, or is everyone seeing that?
It's a systemic issue, but it hits them harder because their benefits are so good. Management said the speed and the size of the increase in claims was a surprise, and it was a major factor, along with that tax charge, that kept SG&A from going down.
But, and this is the key question, if you take out those unexpected things, the tax charge and the healthcare spike,
Hmm.
did the operational improvements pay for the planned investments?
Yes, and this is the proof that the flywheel is working. Management said very clearly that the productivity improvements from things like the checkout scanning fully paid for the higher wages and the extended hours. So without those two unusual items, the SG&A rate would have been positive. It just confirms that the core operation is still getting more and more efficient every quarter.
That's the real story right there. Okay, so let's talk about what people were actually
The
buying.
merchandising teams did a great job. They gained market share almost everywhere. In fresh, sales were up mid to high single digits. Meat was the real star, with double-digit growth.
And was that people buying expensive steaks or was it people stocking up on basics?
It was both, which is a great sign. They saw strong growth in high-end cuts of beef, but they saw even greater unit growth in things like ground beef and poultry. That tells you that shoppers on a budget are shifting their grocery spending to the warehouse to save money on essentials.
What about the non-food categories, the more discretionary stuff?
Even that was strong. Mid-single-digit comp sales. And some categories did incredibly well. Gold and jewelry, special events, health and beauty all saw double-digit growth. People trust the value, even on bigger ticket items.
And we have to talk about the holiday numbers. The scale is just, it's hard to even comprehend.
It's mind-boggling. On Halloween, the U.S. food court sold 358,000 whole pizzas
Yeah.
in one day. That was up 31% from last year.
350 pie numbers were even crazier.
Oh, yeah. In the 3 days before Thanksgiving, the U.S. bakery sold 4.5 million pies. That's over 7,000 pies per store per day.
Just incredible. And the digital business was on fire too.
Absolutely. Black Friday was a record. Over $250 million in non-food orders online. And Costco Travel, which is a huge business, booked over $100 million in trips in the 5 days after Thanksgiving.
And the engine behind so much of this is their private label, Kirkland's Signature.
It's their ultimate weapon. It continues to grow faster than the overall business. It usually offers 15 to 20% better value than the national brand, with the same or better quality. And they're always innovating. New items like blueberry croissants or that new caramel brownie sundae in the food court.
And because it's their brand, they have total control over the pricing. And they're using that control right now to push prices down.
They made a huge point of this, being the first to lower prices, and they gave real examples. The KS chicken pot pie went from $4.29 to $3.99. KS bacon went from $18.99 down to $16.99.
So they're taking the savings from the AI and the pharmacy and the checkout productivity, and they're using it to literally buy down the price of bacon for you.
That's exactly it. That's the model in its purest form.
Last thing here, inflation and tariffs. How are the buyers navigating that?
Overall, inflation was pretty steady. In food, it was a mixed bag. Things like beef and coffee were up, but that was offset by deflation in eggs, cheese, and butter. So it balanced out.
And on the tariffs, how did they avoid passing those costs on?
A multi-part strategy. They consolidated their global buying power. They moved production for some items to different countries. They sourced more goods from the U.S., especially for seasonal items. And most importantly, they just leaned on the Kirkland Signature supply chain, where they have the most control. They're just incredibly adaptable when it comes to sourcing, which is how they protect that low price promise.
This has been such a comprehensive look. I mean, you see a company that is mastering physical retail with this incredible creativity, like putting housing on top of a store while at the same time using cutting-edge tech to make that store more efficient. The path forward seems really clear. It's this combination of real estate, tech, and member data that's going to let them keep gaining market share, even while they're fighting their own costs to keep prices low for you.
Exactly. The key takeaway for me this quarter was their ability to use the savings from technology, the AI, the checkout scanning, to completely pay for their strategic investments in their people. Higher wages, better hours. It just shows you how powerful that flywheel is. Every efficiency gain gets recycled right back into member value, which drives more loyalty, which fuels the whole thing all over again.
It really does. And that dual focus on making the physical store better with tech and finding creative ways to get into cities, it just poses this huge question for their competitors. I mean, if a retailer can make its giant warehouses faster, more accessible, and even more efficient with AI and creative real estate, what's the competitive advantage left for a pure e-commerce player or just a traditional grocery store?
It raises the bar for everyone. The future isn't about getting rid of stores, it's about perfecting them with technology.
Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.